All right, it is 12 noon, so we're going to go ahead and get started with this. Welcome back to our home buying workshop series. I am glad you're here. And this class, let me see here. I want to make sure I've got chat up. Um, this class will be focusing on the very basics of qualifying for a mortgage, which is how lenders look at your income, employment, debts, and to make sure that you can afford the mortgage payment. And so we've done other classes in the series as well. They've all been recorded, and I'll be sharing them with you after this class. You'll have access to them. But at the end of today's workshop, you're going to have a deeper understanding of what it takes to qualify for a home mortgage. And so we're going to cover a lot with this workshop, so let's go ahead and get started. So my goal is to keep the workshops to 1 hour, and we may wrap up sooner. We'll have questions and answers at the end, but please feel free to leave questions in the chat box as we go along. And after the workshop, you'll receive an online dashboard, which is yours to keep. You save the link, that it'll be sent to you. This will be updated with this recording, and plus any homework assignments that are optional, of course, and anything else I think you might feel useful that's relevant to this class, as well as all the previous workshops that we've done so far in this Homebuyer series. But last but not least, please be sure to RSVP for future classes, because each workshop has its own unique link to sign up for. So just a quick little bit about me. I have started off in the title and escrow industry a long time ago, and I've been doing lending for 25 years now, and I've been officially teaching homebuyer classes since 2014, originally for Washington State Housing Finance Commission, but I've since decided to kind of branch off and do my own thing, to where we could really break down the classes into just 1 hour segments instead of doing a 5 hour course over the weekend. But my favorite part, I think, about my job is helping to educate people so they better understand the process. When I was in title and escrow, I used to do a lot of signings to help clients at the month end when things would get really busy. And oftentimes people didn't understand what the mortgage process was or what they were signing. And so to me, this is really important for people to really have a good grasp about, so that you know about this before you get to the signing table, because it's such a big purchase. It's probably the biggest purchase that most people make in their lifetime. So I'm glad you're here. And so in previous classes, I've talked about the 4 C's of mortgage. And it's basically, I compare it to a chair. So, and each C is a leg on the chair. And the one that we're going to talk about today is capacity. And so capacity is the ability to repay the mortgage, that which is factoring in your income, employment, and your debts. And so if you have a chair and if one leg's a little wobbly, that's okay. But if you have 2 legs that are wobbly, the chair gets a little bit riskier. So it's important that we have, as strong as leg as possible. But if we do have things that aren't like perfect, it doesn't mean that the chair isn't good or that you can't buy a home, if we use this analogy. So, but capacity is, again, what we're going to be covering today. And so the 2 main questions that lenders ask, and what they're thinking before they are providing a loan, is real simply, can you repay the loan and will you repay the loan? And again, that is the capacity factor. With qualifying basics, the lender is going to look at your current debts and income, which determines how much mortgage payment you qualify for. The mortgage payment then that you qualify for, along with whatever mortgage program you and your lender choose, will determine what loan amount you qualify for. And then what funds you have for your down payment and closing costs will, in the end, determine what sales price you qualify for. And so let's break down your mortgage payment, since it's part of qualifying. The principal and interest portion will vary depending on your loan amount and the interest rate. But the principal is the original amount of the money that is owed. And the interest is the cost to obtain that money. So it's what you're paying to borrow the money. Property taxes are going to vary by home to home. So it's important before you do make an offer on a home that you talk to your lender so that you can get an updated quote based off of current rates, which are going to change as well, and that home's property taxes. The home's property taxes will change, and the payment portion of your mortgage will change with property taxes as the home's value changes. So that's something to expect, that your payment most likely may go up a little bit from year over year because of property taxes changing. Um, and also your homeowner's insurance will really vary too, and that's something that you get to shop for. And we take your homeowner's insurance, and 1/12 of that, or the annual premium, will be a part of your payment. And if you're putting less than 20% down, then you may have mortgage insurance as part of your mortgage payment too. And there's different options with mortgage insurance as well, to where it doesn't have to be part of your payment. And we'll talk about that in our next workshop. So, but these are all things that are part of your payment and that are part of factoring. And we're going to go into mortgage rates a lot more in a future workshop as well, but I just want you to be aware that there are so many factors when it comes to determining a mortgage rate. So you'll hear rates, especially if you're thinking about buying a home, advertised on the radio or in print or on the TV. And honestly, they change constantly, just like stocks do. And then on top of that, we have to factor in some of these things that you see here. But back to what our class is about with income and employment. And underwriters are really looking for stability with income and employment. So 2 years of history is ideal with your work, but it's not always required. If you've had different employers in the past 2 years, sometimes lenders can connect that employment if they relate. And also, if you've attended college and your degree relates to your employment, we can often factor that or include that into your work history too. So what are some different types of income that are acceptable for getting a mortgage? Uh, there are so many different types of income, and this is just some of the real basic ones, but some of the ones that could be included would be salary, if you're paid hourly, or bonus income may be included, child support, alimony if you're self-employed, Social Security, interest and trust income, as well as RSU income are some of the things that can be included for qualifying for a mortgage. And so basically, if you receive income on a regular, predictable schedule for 2 years, we can probably use it. There are other types of income that can be considered as well, again, as long as it's steady and not a one-time benefit. So if you receive overtime or a paid commission or have a second job and we have a 2-year history, we can probably use that type of income. If you have like a one-time bonus, then something like that we're not going to be able to use. If you have a roommate and they pay their portion of rent to you directly and then you pay the rent, we're sometimes able to use that as income also. So here's a basic nitty-gritty on how lenders generally look at income. So a salary, which means that you're guaranteed to be paid that amount in a year, is the easiest income to determine for qualifying. So we just basically take that annual base salary and divide that by 12 months. If you're paid hourly, bonus or commission or overtime, then that's going to be averaged over 24 months. And underwriters or lenders are really going to be looking for consistency with that income and the hours or the type of pay. If you are self-employed, we're going to generally need a 2-year average of your net incomes. We're going to need tax returns to document that. If you have a second job, lender's going to want to see that you have 2 years of history with the second job, and it has to be the same second job. They can really get picky with second jobs. And if you are receiving child support or alimony, we need to know that there's going to be 3 years of continuance, and that needs to have been steady as well. And retirement or disability, we just need to show that that type of income is going to be continued. But yeah, back to a salary. If you are getting paid that, we can, before you even get your first paycheck, if you have a welcome letter at Strong, we can often use that for income. So this is just an example that with a salary, if you're paid 70,000, for example, we're going to use that right away for qualifying. If you received a bonus and you've had the bonus for 2 years, then we can use that. But it's that bonus portion is going to be averaged over 2 years. Same thing as overtime or any of the other types of incomes. Everything is segmented out and then averaged for 2 years. If you receive a bonus such as a signing bonus, that's something that we can't use as income because it's not going to continue again. I guess unless you start a new job every year, but then that's going to be a separate issue. But the signing bonus can be counted towards as valid funds for closing. And this is just a sample worksheet of what an underwriter or lender might use for trying to determine an income. And you can see, as I've mentioned, like everything is really segmented and broken down as far as the type of income, how often you're paid. We look at, the year to date and the previous 2 years. And so there can be a lot of documentation that you'll need to provide the lender for qualifying, but this is why. So it's really important when you are getting ready to buy a home that you don't make changes during the home buying process. So I had a client who's a vet in Western Washington, and she got a promotion while we were in the process, or it might have been even just before the process of buying their home. And she went from having a really nice base salary to having a much lower base salary, but this potential to earn a lot more of commission. And she was already making more with this change right out of the gate. So it was a great move for her, except for that when it came to buying a home, we couldn't use that commission at all because she had no history of making commission. So we were really fortunate that they had enough income with her spouse that they were still able to qualify when we just were able to use her smaller base. But it could have been, not worked out in our favor. But so it's just important that you not make changes before buying a home or during buying a home, or that if you are looking at doing something like that, like having something restructured, because the vet could have delayed having this change possibly until after they closed. The lender's not going to care about that. But do keep in communication with your loan officer so that they know if there's going to be any changes to your employment. So if you're self-employed, be prepared to provide extra paperwork. I mean, we're going to probably need 2 years of your to complete business or personal tax returns, K-1s, all those things. And so we generally use your net income as well as the year-to-date profit and loss statement. And sometimes what we might run into with a self-employed borrower is oftentimes they might want to, with their income tax returns, not declare as much income as possible, like have so that they're not paying as much taxes. And so sometimes what we can do with self-employed borrowers is there is other programs if we need to, such as alternative document loans or bank statement loans that we can use for their income, which is based off of what the monthly deposits are. So if you are self-employed and you have a lot of write-offs, that we may have other options for you too. So second jobs or side gigs, as I mentioned, can be a little more challenging too with proving that income. And so what we need to have is a 2-year history. It needs to be steady, and you have to pay taxes on it. So if it's so we'll need W-2s and pay stubs to document this income. If it's in a job where you're just not paying taxes, maybe you're an artist or something like that, and you just sell a couple paintings here or there, well, for one, it's probably not going to be enough income to help you qualify, but the big thing is consistency and that it's declared on your income taxes. If you receive child support and alimony, that income may be counted if there's a minimum of 36 months remaining at the time of closing on the loan. So if you are receiving child support, for example, and if one of the children will be at an age where the support is no longer going to be required, let's say they're 17 and it stops at when they're 18, if it's not going to be required within 3 years of closing, then we can't use that child's income. So we do need, or that child's support for that child. So we do need to have a 3-year continuance with that as of the date of closing. And the other thing that's important too that we sometimes see with child support or alimony is that if the paying ex-parent, or not ex-parent, that's awful, sorry. If a parent who's paying support is not consistent with the payment, so one month they're paying $100, next month maybe they don't pay anything, and then the month after that they pay $200 or $300. We probably won't be able to use that income because it's not consistent and steady. So Any type of income that is being used for qualifying needs to be documented, and it's going to vary depending on the type of mortgage that you're qualified for and what requirements for the underwriting program are. And so depending on the clients that I'm working at, I might try a lower doc program to where they're really like 1 year's tax returns. And but sometimes, we might be getting a better rate or a better program for a client if it's a higher doc program. So it's all going to depend on the individual and the program that we're doing. So before you start digging up all your paperwork in tax returns and everything, I would wait until you talk to your lender and get a actual list from them as far as what you need, because this list is very general as far as what may be required. And for example, if you are not self-employed, we may not need 2 years tax returns. And lenders do go back 24 months for qualifying. And so gaps within those months will need to be explained to an underwriter. And there are reasons why somebody, may not be employed for a full 24 months. Lenders are just wanting to make sure that you have steady employment and income. So you're probably seeing a trend of what they want to see here. If you do have gaps, a lender may ask for an LOE, and there are so many abbreviations in the mortgage process. So if your lender does just talk to you in abbreviations, stop and make them explain what they're trying to say to you. So an LOE is a letter of explanation, and it's a common thing to be asked for, and it's not just related to employment. It can be if you have a bounce check on your bank statement, or if your income is declining, or I mean, there's many reasons. If you have a lot of inquiries in your credit report is a very popular one too. So all it is a letter to the underwriter. It can be pretty casual, and they just need additional information which explains the circumstance, in this case, on why there's a gap in your income, or gap in your employment, or declining income. Here's an example of what a underwriter is essentially looking for with a letter of explanation. And so it just needs to address what's happened, how or why it happened, what steps you're taking to make sure it won't happen again. And you can even wrap it up with a success story. So it just needs to make sense and be truthful and short and sweet. And now we have more abbreviations for you. So after the lender has your application, and your supporting documentation for your income, and you're getting ready to start the process, they may do what's referred to as a VOE, or verification of employment. And this can be done online or by an email or phone call to your HR department or manager to confirm your employment and income. So during the mortgage process, you're going to see that everything is verified and re-verified. It's very redundant, but there's just different methods where these steps have to take place with the re-verifications, and that's unfortunately, because of fraud that's happened in the past. So, and also it's important to know this verification of employment is done again just before closing, and also your credit is re-verified just before closing too, just to make sure that you haven't taken out any new debts since you started the loan application process. So wait on those large purchases for your new home. So a couple of years ago, I had a couple who were getting a refinance. Actually, they weren't actually buying a home, but the husband was an electrician, and he'd worked for his company for years, a company. And I wasn't aware that he was getting ready to quit and start his own company and become self-employed. And so it was just literally days before closing, they'd signed their final papers. I think they thought they were just done with everything and getting ready to close. But when the verbal verification happened just before closing, that's when we discovered that he had quit his job. And it was shocking. I've never had anything happen like that before or since. But so I make a point to tell clients about this, that don't make any changes to your jobs until after closing. We were super lucky because the spouse had enough income to qualify, but it did delay our closing by a few days because we had to rerun everything and basically do a quick new application because the terms had changed as far as his employment. Everything worked out. It was just extra stress. But again, don't make any changes to your employment before closing. Make sure that you stay in communication with your loan officer. So again, the basics of qualifying for a mortgage is that your income and monthly debt obligations determine the maximum mortgage you can qualify for. And this is known as the debt to income ratio, or DTI. And the monthly payment you qualify for will determine the loan amount. And when we add the amount of funds available for down payment after taking away and factoring in the closing costs, we can determine the sales price of the home you qualify for. And so DTI, or debt to income ratios, are big factors for qualifying. The front end ratio is the total proposed mortgage payment, and we take that by dividing your monthly income into the mortgage payment. And so it used to be, back in the day, that would be around like 28%, but the front end ratio doesn't carry as much weight typically with most programs. Some it does, but most it doesn't. The back end ratio is typically the most important ratio, and that is when you add in your debts, your monthly debts, plus the mortgage payment, and divide your income into that. And so different programs allow for different back end ratios. A 45% is pretty typical for a back end ratio. FHA loans can go up to a 55% of gross income for a back ratio. But if you think about that, do you think that's really a good idea to have 55% of your gross income going towards your mortgage payment and debts? And I mean, leaving you only 45% of your paycheck, which then you're going to take out your taxes that you pay, your insurance that you pay, and then it doesn't leave you as much for groceries. So, but oftentimes when lenders go to 55%, like with an FHA program, there may be compensating circumstances with that, like a spouse or roommate who's not able to be on the application, but there's additional household income that makes that work. So there are things to keep in mind with that. So debt to income ratios are just one of the guidelines that underwriters use to help qualify you for a program. And the more monthly debts that you have, the less loan amount you're going to qualify for. And they do look at minimum debts or minimum payments that's due on your debt. So if you have a credit card and the minimum payment due is 25, but you always pay 125, we're going to look at the 25 for factoring into your debt to income ratios. So your credit report is scrutinized. Even your bank statements are considered if they see a regular payment made on that. If you've co-signed for someone, we may have to factor that payment in as well. And if you owe child support or alimony, that's going to be factored as well. So some debts that may not be counted may be an installment debt with less than 10 payments due, like a car loan. But if your car loan has a huge car payment and the underwriter decides that it takes up too much of your income, they still have that right to factor that into your payment or into your debt to income ratio, which would impact qualifying. Something else that may work out in someone's favor as well is like alimony sometimes may be deducted from gross income instead of treating like a debt. And so what we have to do as a lender is run those numbers both ways to see how that works out. So it's something to keep in mind too. So for that alimony can be treated differently to help with qualifying. So this is just some rough numbers. For home buyers who are not self-employed, we look at the gross monthly income before taxes or insurance are taken out of your paycheck. And typically we'll go to 45% for that debt to income ratio. And again, we can go higher, but 45 is just kind of a safe number to start with. From there, we deduct the monthly debts, and then the remaining amount is the maximum mortgage payment that you may qualify for. So with this scenario, I'm using a gross monthly income of $7,000 a month. And if we times that times 45%, then that leaves us with $3,150. And then if we take away, let's say they have $500 a monthly debt for a car payment and credit cards, that would leave a maximum mortgage payment with the 45% ratio of $2,650. And so this $2,650 is to include the entire mortgage payment, as well as the property taxes, homeowners insurance, any mortgage insurance, and if it's a condo or PUD, any homeowners association dues as well. And so this is kind of how a real rough overview of how this would work. So then the mortgage payment you qualify for will determine the loan amount that you qualify for. So again, we have a mortgage payment of $2,650, and the taxes and insurance, let's say, are $450 a month. The principal and interest then would be $2,200. And if rates are around 6%, and this is just a number I'm throwing out, I'm not quoting live rates, this is just for our workshop, then that would give us a loan amount of just under $367,000. So if the buyer had roughly $50,000 in funds for buying a home, once we take away the estimated closing cost of about $10,000, that would leave us with about $40,000 for their down payment and roughly a sales price of $406,950. Again, these numbers are really rough, and just to show you an example of how this could work. Now, in our last workshop, we talked about down payment assistance programs and seller contributions. That could help increase the sales price for what you've qualified for, because it would help alleviate the funds needed for closing. So we shared this slide during the credit workshop, and just how buying a car is a triple whammy to your credit score. I mean, it is so. Whenever I hear a client say, yeah, we just bought a car, our credit's great, my heart kind of sinks, because I know their score is probably going to be a bit lower than what they expect. And car salesmen will tell you a million things except for that this is going to hurt your score or your odds of qualifying for a home. So based on the example that we just had, instead of qualifying for a $406,950 home, if someone just bought a car and they had a $600 car payment, they would now qualify for a $306,950 home. So it really does impact your buying power. Car payments are really hard on debt to income ratios. I'm going to take a quick drink of water. I hope I'm not talking too fast. So I'm trying to talk slow for me. So if we had two of the exact same borrowers, and the borrower A with the green writing has a 43% debt to income ratio for her back end ratio, and she's got a stable job, she's going to have a really easy time getting approved for a mortgage. If buyer B has a higher debt to income ratio of 51% and a brand new job, she's going to be considered borderline. And so, but there's things that buyer B could do to improve her scenario. So if their income's the same, it's possibly, buyer B just might qualify for a lower priced home, or she might have to put more money down. And it might even take looking at her debts, and maybe there's some that she can pay down or that we can restructure. But this is something that's really important to meet with the lender and have a discovery call to see, create a strategy and see what can be done to help put somebody in a better position. Another option could be that maybe buyer B needs to ask her parents to co-sign. In fact, I'm just closing on a loan today where the parents co-signed for my clients, which is pretty cool. So parents with good income and credit can co-sign on a mortgage with you. They apply just like you do. So they are a co-borrower exactly the same as you on the mortgage. So they have to allow for the credit to be ran and their debts to be reviewed, supply all the income documents, do everything basically that you're doing too. And then we factor in their debt to income ratios with your debt to income ratio. So they can be removed from the mortgage at a later date with a refinance or a redo on the mortgage once you qualify on your own, or if you sell the home. So, but meanwhile, they are on the mortgage with you. And so it's important to know that if someone happens to be late on the mortgage, it will hurt their credit. And it also may impact their ability to buy or qualify for other mortgages in the future. So until you have a proven payment history. So it doesn't work for everybody, but it is definitely an option to be aware of. Something else to consider is that buying with a friend can help you get into your first home. You'll both qualify for probably a higher sales price. With both incomes, ideally have a larger down payment. And when you go to sell the home, you might have more proceeds, because assuming that you're buying a bigger house than what you would have than buying on your own. And you could even consider maybe buying a 2 to 4plex where you could rent out additional units and possibly use that income for qualifying and also to offset your mortgage payment. If you are going to do something like this, personally, I would suggest having an agreement prepared between the two of you, kind of like a prenup, just in case things don't work out, or for when you decide to sell the home. Maybe somebody wants to keep it and someone doesn't. But and I'm not an attorney, but I just think it doesn't hurt to have something like that in writing to fall back on. Another home buying hack, which I kind of touched on earlier, is that if you have a roommate who is paying their portion of the rent to you directly and they plan on moving with you to the next home, you might be able to use a portion of that rent they've been paying you as income for qualifying. So the biggest catch with this is that we have to be able to document it, that these payments have happened for the last 12 months. So and that's been a great tool too for helping people buy their next home and qualifying for more home. Something else I like to suggest for clients is that if you um, have an idea of what you would like your mortgage payment to be, and it's higher than what you're currently paying in rent, practice making that monthly payment. So you can put the difference up into a savings account marked specifically for your home buying. And but then when you go to meet with your mortgage advisor, you can discuss whether savings are the best uh, for your plan, or if you're better off paying off debt. So it can really depend from person to person if you're better off having that savings account for down payment or restructuring your current credit scenario. So again, before paying down debts, meet with your mortgage advisor to schedule a discovery call, review your finances and goals so that you can create a plan that's specific for you. It could be that saving for a down payment is more important than paying down debt. And if you recall from our workshop on credit, sometimes paying off or paying down credit can actually hurt your scores. So that's not something that you want to do just before getting ready to buy a home. So with your homework for this class, it's optional, of course, but it's to determine what your personal debt to income ratio is. So you can gather your income and documents in your credit report that I'm sure you pulled from the last credit workshop to determine your income and debts. And if you need my help, I'm here. And a big congrats to you because you've taken another step towards homeownership. And even if you don't buy now, you're hopefully learning from these workshops and you've discovered basics of getting pre-qualified for a mortgage. And do I have any questions? All right. So our next workshop will be on the mortgage process, going from pre-qualifying, getting pre-qualified to offer accepted. And haven't decided if I'm going to do one or two in December yet, but it'll be on my blog at the Mortgage Porter, so please check that out. And after class, you are going to be receiving this mortgage dashboard. This is what it'll look like. And each of these modules are updated as the classes are finished, and they're all recordings from previous classes. If your real estate agent referred to this class, please let me know so that I can thank them. And if you don't want to wait for our next workshop to talk about the home buying process or to learn more, please feel free to reach out to me so we could schedule a discovery call. You could scan this QR code or reach out to me directly from phone call or email. I'm always happy to help you or anyone that you know with your mortgage or buying needs. I hope you have a great week and I hope to talk to you soon. Take care. Bye-bye.